Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. It's been another busy week of news, and today on the show we're taking in the micro, the macro, and metal. We start with FTSE 100 maker of seals and fasteners Diploma, whose big share price gains of recent years were reignited earlier this week with publication of its half-year results. Valeria Martinez will talk us through those figures and ask whether it still justifies its lofty valuation. Then we look at asset allocation, asking if the default form of investing for inexperienced investors and those who just want to keep things nice and simple, that's a global equity index fund, is still fit for purpose. Alex Newman will discuss his cover story on the subject. To conclude, we talk about Cobalt, the metal touted as key to the energy transition that has nonetheless seen its price slump over recent years. A new vehicle is due to list in London soon, but there are, of course, political and social aspects to this story too, given the way mining is affecting the Democratic Republic of Congo and how its export ban is affecting the market too. Alex Hamer is here to examine the finer details. We are going to kick off with Diploma. Half-year figures out on Monday. The company's share price is up by about two-thirds since it featured in our ideas section about 18 months ago, so it's been a pretty lofty rise for the company ever since it's joined the FTSE 100 back in 2023. Valeria, these figures again were very well received. What went right? What did it talk about in the half-year figures?
I think that the market response was mainly due to the fact that they upgraded guidance, but the half-year results itself were quite strong. So on an organic basis, sales rose 9% with the controls division sort of leading the way. Life sciences did well too. Performance in the seals division was a bit mixed. That one has been dealing with a really tough manufacturing construction market for a while, especially in the UK. So that was a bit, they reported flat growth there. And actually, it was 6% lower on a reported basis. But it's important to say that the organic figures were boosted quite a bit by an acquisition that they made last year. It's this specialty fastener company called Peerless. That one's been doing really well, growing at double digits. But yeah, it operates in the US aerospace market, which is quite a hot area at the moment. And then also in terms of the bottom line, operating profits beat analyst forecasts as well. Margins ticked up by 1.9 percentage points. So yeah, a strong performance on both the top and bottom line here.
Yeah, this is one of those companies that it features quite a bit in our, I think it's the high cap quality screen that we run in print online once a year, partly because it has done a very good job in recent years of growing all these things you've spoken about. Its top line, the bottom line, the return on equity has generally been pretty good. It is a buy and build business. It does seem that Peerless acquisition, as you say, is really driving growth at the moment. It had, I believe, has another fasteners business, but this one is focused on the US, focused on that aerospace market that requires a lot of fasteners, I would imagine, not knowing too much about the exact nuts and bolts required, but that's very much Diploma's bag, isn't it? Those kind of small widgets, little things, but key industrial supplier as it is. It's involved in a lot of different end markets. Why don't we talk about the guidance in a bit more detail as well? What's it said about the second half of the year? What's it said that, as you mentioned, really caused the share price to take off?
Yeah, so the guidance that they originally set was set out in November. They had originally said that organic revenues would go up by 6%, but they've actually now said that it expects 8% organic growth. And then on the margins front, they're now guiding for 22% up from 21. So yeah, confidence is clearly high.
We should say with the amount of acquisitions they make that there is a slightly different situation in the way they classify those. They do, I think, immediately include acquisitions in their organic growth. So whereas a lot of companies would tend to wait 12 months before putting that in there. So organic has a slightly different meaning in this case. And Peerless has clearly driven a lot of that. It seems to be growing at about 20% at the moment. That might create some issues later in the year, though, which the company, notwithstanding the upgraded guidance, did flag as well, because we're getting to a point where we start to lap the appearance of Peerless in the figures for the first time, so that makes for some tough comparatives.
Yes, I mean, they've signaled that in the second half, growth will probably moderate a bit, even just optically, as you say. They're lapping up the full year of ownership. The acquisition was completed in May of last year. So yeah, there would be a bit of a tough competitor there.
What about other deals potentially coming through? It does like to make a lot of deals, as we say. It has been making increasingly large deals in recent years. There was one small one, I think, announcing these results, but what's it saying about the future?
Yeah, so they've been very active on the M&A front over the last few years. As you said, the first half was a little bit quieter. But yeah, management is not too concerned. They've said that deal flow won't always be linear and that they're focusing on quality over quantity. But they did say that the pipeline is as big as ever and that they're now much more focused on organic growth. But yeah, if they make any deals in the future, the balance sheet is clearly supports that, as well as their track record. They have a solid track record of M&A. So I wouldn't be surprised to see more deals coming through.
Yeah, they've still got, as we said earlier, very good return on capital measures, even with these big deals coming through. So that does support, as you said, their ability to do more. What about the environment in which they're operating? Because while aerospace clearly is really working out well for them at the moment, there are concerns about the US in particular, or there have been concerns about US economic growth. They have a variety of end markets, as we say, all kinds of different things. But what have they said? What's the commentary they've given about how they see demands across the board in the US in particular at the moment?
They're actually really, really bullish on the US. They keep saying that that's going to be their number one market moving forward. And actually, they're seeing things improving in the short term. So they've actually seen better trading in the US, especially in, hot areas like data centers and aerospace. Even on the seals business, they're also seeing some signs of life there. They did say that on the medium term, actually, this move of more manufacturing and industry coming back to the US actually plays directly into the hands, especially on the seals business. So yeah, very bullish across the board.
I guess the concern some people would have is that because you've seen such strong growth figures in the US, not just from Diploma, but economically speaking in general, that any sign of a dip there could create a bit of a change in not the investment case, but sort of the near-term prospects. But for now, it all seems quite positive. They do have other areas, of course, in which they're interested in other parts of the world. There was a big European acquisition, or decent size acquisition, a couple of years ago of a hydraulic and pneumatic connectors manufacturer, I think, which they said at the time that would take 1 or 2 years to start growing properly. So that might be something that people can start looking for if European growth conversely starts to improve a little bit. What about tariffs then? We can't escape that question. The tariff situation is clearly very fluid, but what is the company's potential exposure if we have a situation where they're going to be facing much higher rates?
It has some exposure. It is manageable though. So over 75% of their products are sourced locally, and raw materials actually are a huge part of the final cost. They do have some businesses, just Windy City, which is their wiring business, that buys copper from Canada, and then another business called Hercules OEM that gets some seals from China. So there's still a bit of exposure, but for now, not a major red flag.
Yeah, the business model, which is quite decentralized as well. This is a strength of that model, isn't it? Because they tend to be, they probably disagree with the phrasing hands off, but these businesses all have their own centers and headquarters, which is helpful if you're getting involved in a trade war situation. And that Windy City business has been quite promising for them as well, hasn't it? In terms of that's one that really feeds into the data center market with the wiring and what have you. So there are strengths there as well as a potential tariff exposure. Let's wrap up just by looking at the valuation, because that's always been the slight fly in the ointment potentially with Diploma, insofar as because it's such a healthily performing business, you tend to have to pay up for it. How does the valuation stack up at the moment relative to history and whatnot?
It's still rich. There's no question about that. The forward P is currently trading at around 29 times, which is well above the sector average. And if you compare that to something like Bunzl, which is around 13 times, although to be fair, this company has had its own issues recently, it does look expensive. But what some analysts and investors would say is that you're paying for consistency here. Obviously, it's had reliable organic growth, resilient margins, as I said earlier, a great track record in M&A. So yeah, it's definitely not cheap, but this is a company that you could qualify as a quality compounder, if I can say that. So yeah, the market's often happy to pay a premium for those types of companies.
Yeah, well, it's certainly one of the standouts in the FTSE 100 over the past few years, and potentially that might continue. For now, though, we are going to look at global markets in a bit more detail and focus on the US in a slightly different way, Alex Newman, because our big read this week is all about the Global Equity Index Tracker Fund. Lots of words there you might want to stick together, but effectively a passive fund tracking the global markets, a very easy, simple form of investing in theory, but things might be getting a bit more complicated because of some of the issues which we've just alluded to with the US.
Indeed, yeah. So I suppose the idea of this piece and the kind of argument behind it arrived a few months ago. So at the end of 2024, I think markets were awash with all this commentary around American exceptionalism. I'm sure we fueled some of those fires in the magazine. It's part of, I suppose, reflecting our job of reflecting the narratives that are in stock markets. But this kind of reached this real peak at the end of last year where it was kind of said that the US was almost the only investment game in town. So it had the strongest, most business-friendly economy, the best technology, the best global reach, the strongest currency, and this capital market or a stock market with such unparalleled sort of depth and liquidity that it was sucking in every promising new company that was thinking of listing, and also luring the best businesses on other global exchanges. So within, I suppose, global markets, there was no clearer expression of this narrative than in the MSCI World Index, which is kind of the sort of describing the piece as the North Star for how global equity fund managers and investors think of market quote unquote returns. At the end of 2024, the weighting of US stocks within that index, in the developed version of the index, had reached 74%. So that was on following back-to-back annual gains of more than 20% in the S&P 500, and we saw this big post-election surge in the US dollar, which also helped juice the value of the US stock market relative to everything else. At the same time, we've seen this multi-decade kind of embrace of passive investing, which has been largely vindicated, I should say, which has kind of seen legions of institutional and retail investors opt for market returns, which, as we've outlined, have been US dominated. So, purchases of tracker funds or funds which track the MSCI World, like those offered by BlackRock, Amundi, UBS, have become a real staple, cornerstone, and sometimes the entire portfolio for lots of investors. So that that's kind of where we got to. That's the that was the impulse for writing this piece, because we'd reached this real sort of precipice where there was so much so much emphasis placed on the US market, and I think then 2025 came along.
Indeed. You're right, though. This piece has been in the schedule for a couple of months, or more than a couple of months. So it's not prompted by Liberation Day specifically, but clearly that has heightened the potential contradictions or the tensions involved in global investing, as you've just outlined. I mean, is this just another reminder that nowadays that passive investing is actually an active form of investing, certainly when it comes to asset allocation?
Yes and no. No, because if you take passive or index investing at its word, it's not a narrative, it's not an active decision, it's just an entirely neutral reflection of relative asset prices.
Sure.
So, and the fact is that hands down, America's been the best, it's been the market winner for many years, which incidentally means it has been brilliant for any market way to develop all country global equity index. So in that sense, if you had really just embraced index investing and global passive investing, then it would have worked out very well. I suppose if you take a step back and you ask, what does 74%, okay, it's come down ever so slightly now to 71%, 71% of a global equity portfolio, all focused on one country, one stock market, with its own risks we are now growing to understand are really there. And, perhaps America won't remain number one forever. What does that actually look like? And it's hard. I think it's hard to argue against the idea that it is anything but quite an active call on the future. So, if you almost boil down what the value of MSCI Global or World Index stands for, if you're going to buy it today, you're kind of saying the net present value of developed world stock markets assumes that between 2/3 and 3/4 of all future profits are going to come from US stocks. So not only is the US market ratings, which are expensive relative to both their own history and to other exchanges, justified, but it's almost going to keep growing and growing at a faster rate than the rest of the world. And in other words, that it's more than twice as important as the rest of the world put together. That feels like quite an active call, I think, that if you try and take a step back and remove the mechanics of passive investing, and that, I think that is a potentially big issue. And the other thing I should just add, and we don't really touch on this in the piece, but it's not necessarily just about passive investing, because the MSCI World Index, it's so important for active managers as well, that when they are building a fund and trying to add alpha, investing in a global universe of stocks, they can't stray too far away from the way that the index is composed, because they risk, because it presents all sorts of risks for how they might miss the so-called sort of tracking error of their active funds away from what the passive market index will offer. So in some cases, you'll have fund managers that underweight America. In other cases, they've gone understandably overweight, because they have taken the view that what has worked so far will continue to work tomorrow. So it's not just, in a way, a passive story. This is kind of about how global stock buyers think about future returns.
Indeed. I mean, it is amazing to think when you look back on the other chart in the piece, you think mid-90s, which admittedly that is 30 years ago, but the US weighting then was about 40% of the MSCI. Now, well, certainly at the start of this year, we were getting close to double that. It has come back a little bit with the relative performance we've seen in 2025. But for those people who want to find a way to offset this or ameliorate this or hedge against this, even in some ways, what are the options out there while keeping things relatively simple?
Yeah, so I'll kind of very briefly sketch out 4 options that we sort of discuss in the piece in greater depth. I mean, the first one is to trim the size factor by equal weighting the global index. So I don't think ETFs are available for the all-country version of MSCI's index, but certainly I know Invesco has an ETF which can equal weight all the constituents in the MSCI World Index. So that will by definition lower your exposure to tomorrow's brightest stocks, because it assigns the same weighting every quarter to every company. But it should lower the US large cap risk, which is a big concern for many. A second way you could lower your exposure, if again you want to just kind of stick to the passive investing as sort of your broad method of building a portfolio, would be to switch to a global tracker with a value tilt. So I know iShares offers them. I mean, there's lots of the big fund managers offer like a value MSCI World. So that is the virtue of both boosting geographic diversification, because a lot of the cheaper value stocks are found outside of the US, and therefore it lowers exposure to both the US and gets you on side with one real persistent source of alpha historically in markets. Third, you could kind of increase your exposure to the so-called ex-USA ETFs. So these are just ETFs which are like MSCI World Index, but it cuts everything out of America. So you could keep MSCI World Index, for example, and have an ex-USA index to sort of to balance things and just lower that American exposure, or you could buy an emerging markets tracker if you feel that's just very sorely underrepresented by your global equity fund. The fourth option is to just try and cut out America altogether, which I think is easier said than done. Not only because a lot of the global markets will still have exposure to North America, but also because yes, we can say that it is is a richly rated market, but depending on how you measure things, sort of between 40 and 50% of global corporate profits are still coming from America. There is a reason why it has become such a huge portion of global indices, because this is the world we live in, and this is the scale that American companies have grown to. So yeah, those are the kind of four approaches you might take if you are concerned at all with the way things are.
Yeah, it would be a bold move to scrap the US entirely, or go, certainly if you've been having 70, 60% exposure for several years, wouldn't it? But we can maybe come back to that in a moment. But there are other things to be aware of, aren't there, in terms of what the companies in each of these indices actually do and where they have their own exposures, because as we're often told and often remind people with the FTSE 100, to take the obvious domestic example, these aren't all companies that would necessarily be defined as, in this case, UK, and the same applies to other indices too. So there are other ways to look at the way in which these indices are made up, if you boil it down a bit more.
Yeah, and that kind of gets back to the point on the source of global corporate profits. So to take the S&P 500, for example, on an equal weighted basis, so just the very standard average of all the constituents in the S&P 500, they make about the average constituent makes about 72% of its sales in North America. If you market weight that, so you, as index funds do, add the weighting of the larger companies, then that reduces to about 60%, because the biggest companies are some of the most globally facing. So think of Apple, for example. It earns only about makes only about 2/5 of its sales in North America. So there is an element of the US market which is global already. So by just sort of simply cutting out America, you are also cutting out some of the global pool of corporate profits. At the same time, though, you have to reflect that Japanese, European, Korean stock markets also make a lot of their sales and their profits in North America as well, albeit at slightly often lower valuations in their stock prices. But that's just to also add in, I suppose, the factor of how exposed you are to the US economy, which, I mean, we probably shouldn't go into the tariff situation now, but that might be another consideration when investors are wondering what is the appropriate allocation to America.
The net outcome of all this potentially is, or certainly if we accept these arguments, is that what is the simplest basic form of investing has necessarily become more complex. But equally, as we've spoken about, and as you mentioned in the piece, over time, if the US were to underperform, that would, over a long period of time, admittedly, that would balance out in the index itself. And of course, there is an attraction to having just a one-stop shop that you can just set and forget. You don't have to do anything with. You don't have to think about too much. So even by sort of raising these questions, are we implying that this decision is going to get more complex if you want to think about it? I mean, for a lot of people, I imagine they'll prefer not to think about it at all and continue to not think about it and just keep holding that original global equity fund. It's quite a difficult thing even that is a difficult thing to balance.
Yeah, absolutely. And what is the right level of American exposure? I think, as I sort of touched on before, the first thing to say is that passive purists will just dismiss that question out of hand, because you buy the market at the price that's set by the market to own everything, and that's your only realistic chance of owning tomorrow's winners. We can't really dispute the maths of passive investing. It has also worked very, very well. But did anyone anticipate the situation it would lead to? Did anyone think that the entire world would be shrunk to such a almost insignificant piece of the global stock market portfolio by dint of America's decades of sort of America on the rise? I don't think they did. So, and the other thing we should acknowledge is that the way these indexes and tracker funds are constructed, so full of arcane and sometimes inconsistent rules about where companies are listed, and it doesn't really matter about the source of their profits, so long as they're, for example, they're listed in a developed stock market, that you are in some ways taking active decisions just by following this passive strategy. So hopefully what the piece communicates, because some of these can get a bit technical and slightly arcane, is that actually you don't have to take radically different decisions in your approach to thinking globally and investing in the global stock market. And you don't have to just to potentially reduce some of the all-in focus on America, which is essentially what you're obliged to bet on today if you're going to buy one of these standard truck funds.
Indeed. Well, as I say, that is the big read this week. It's a subject that is going to keep progressing inevitably as the months and years go by. But do pick up a copy of the magazine, look for it online, because there's certainly some weighty considerations in there that are worth giving due thought to. Now, though, we are going to look at Cobalt. Alex Hamer, you're here to discuss this with us, because the news here is that there's a new London vehicle coming shortly. But why don't we set the scene a little bit by talking about what's happened in the past few years, because there's been a couple of bull runs for the metal, certainly 2021, 22, as you would expect by something that we hear is going to be a key part of the energy transition. And yet the big detail underlying all of this is that the price has actually performed very badly over the more recent past. So what can you tell us about why that is and what the conflicting forces are here?
Thankfully, after that very detailed section from Alex Newman, where there's all these small levers that will hit your portfolio, this is much more metals come out of the ground in large volumes, price go down.
Situation, yeah.
Yeah, which is kind of the track on which my mind works a bit better as well. So let's all be thankful for that. But as you say, cobalt has been one of the energy transition metals or battery metals that, when the mining and car world first started getting excited about this shift to electric cars, this cobalt, which is a key part of lithium-ion batteries, a style of battery called nickel, cobalt, manganese batteries, which are about 50% now of the lithium-ion vehicle battery market, that the price shot up effectively. And now most cobalt comes from the Democratic Republic of Congo. I assume listeners will have an idea of little kids digging holes, chipping away at ore bodies and carrying up and selling it to middlemen in markets. That is a bit of the market. That's about 15% of the market. The rest of it now is largely big Chinese mining companies who are desperate to get copper out of the ground in the Congo and get that over to China. Where cobalt comes into it is it's a byproduct. So they increase copper mining, more cobalt comes out of the ground. And to finish the picture with a stat, last year the cobalt market demand was 200,000 tons. So it's not a big market. Supply was 250,000 tons, which is, as you can see, a pretty significant oversupply. And where this new company, which is called Cobalt Holdings, where they come in is, the idea is effectively buy cheap, hold, potentially sell, well, not even sell, just hold until it appreciates in value, and potentially sell a little bit later down the line. And forecasts have changed a little bit on the supply-demand curve. Previously, there were thoughts that the market would go into deficit in 2027. A few people are still pushing that forecast. Now it's about 2030 from the Cobalt Institute, which is an industry-funded body, is probably optimistic as well. But the idea is that they've set up this new vehicle, Cobalt Holdings, to buy cheap.
There is another aspect to which you alluded to the oversupply argument. Not just, well, part of the reason that there is so much oversupply is that the use of the metal hasn't taken off in the same way people expected, as you alluded to with the forecast there, which is partly due to EV transition not happening as fast as people expected, but also because people are finding substitutes and it's not playing as key a role as was thought several years ago now.
Yeah, and if we went to China now and looked at the cars people were driving, there's a lot more smaller electric vehicles. So even the little light commercial trucks, things like that, that are using batteries that have the chemistry called LFP. I won't dive into it too much because it's not that exciting. But effectively, it's a battery without nickel and cobalt. And the reason they've moved to that, partly because of cost, because of, now cobalt's trading at $33,000 a ton. It was at times over $80,000 a ton. Nickel hasn't dropped as much from its peak if you take out that short crunch that happened a few years ago. But that was also getting quite expensive before they ramped up supply of that as well. So there has been that shift. I think the proportion that I talked about of these NCM batteries in the market is a fair bit lower than we might have expected a few years ago. But so there is a substitution risk here. But I think, cobalt will definitely be needed in greater volumes. And I think, talk of electric vehicles slowing down massively is, it's basically not meeting significant growth forecasts. But the market is still definitely growing, and we need more of these metals. So, another way to look at it is Rio Tinto has invested massively in lithium in the past 2-3 years, even though that market's also been in oversupply, and they've been shutting down certain mines in Australia, for example. But for a mining company like that to keep investing in it shows that there should be a market in the future where supply is not so close to demand or not so far above demand.
As you spoke about just now with the reference to children mining on the streets of the Democratic Republic of Congo, because they are such a big supplier of cobalt and such a big resource there, it has completely transformed their society, often in ways which are quite bad for the society. It can be quite unregulated. These artisanal miners, as it's called, which is anyone doing it off their own back, effectively. And as you can imagine, everyone trying to get involved in that is not necessarily a great state of affairs. But there is also another political component to this, in that they have now banned exports in an attempt, or temporarily stopped exports in an attempt to stop the price from falling further. So that's another situation to be aware of when considering this kind of thing.
Yeah, and I think it's a really interesting moment for the market. And the reason it's worked so far, it's worth saying, the price of cobalt's gone from low $20,000 a ton to $33,000 a ton this morning. And so that has worked. And the way Jake Greenberg, who's the one running this Cobalt Holdings, the new vehicle, the way he put it to me was that this put a floor under the cobalt price, because any time it gets too low, it seems as though the DRC will slow down or stop exports. It is a bit of a balance against this byproduct situation where, cobalt is a passenger to copper and sometimes nickel, and copper is a much tighter market with higher prices compared to historic averages. And so I think it's always going to be a struggle unless cobalt demand increases significantly. It's also the reason it got so expensive is because you can't really increase primary cobalt supply either. And that's the problem the market faced a few years ago. But now with the DRC trying that method, which, as I say, has had a positive impact on the price. Yeah, I think Jake's right. There is a bit of a floor under the market. There is potentially the risk that if they push that too hard, then there are further substitution risks, especially with the type of batteries used on Chinese EVs. And as we've seen, Chinese EV makers are becoming more and more important to the world market. And I mean, Tesla also tried to cut out cobalt. It's not just a Chinese thing. But I think that dynamic will be interesting. And there's other suppliers, but the volumes are pretty low. Like the other way that if a London or UK investor was really keen to get cobalt exposure, the other option is Ecora Resources, because they own a stream, so a proportion of supply from a mine in Canada that's a nickel mine, and then that stream gives them a bit of cobalt to sell every quarter. And so their twin revenue streams at the moment are coal and cobalt. So I guess almost a bet each way.
The other point you make when writing about this week is it's quite similar in more ways than one to yellow cake. Can you talk about some of the similarities in terms of structure and also people, some of the people you've spoken about already?
Yellowcake, if listeners don't know it, is a London-listed vehicle. The same idea as Cobalt Holdings, where the managers thought there was a low in the uranium market, aka Yellowcake, and raised enough money and put in place an agreement with Kazatomprom, the Kazakh uranium producer, and bought up a whole lot of uranium. They did really well. They picked the market effectively. They were helped by the war in Ukraine because Russia's a major player in the uranium market. Obviously, Kazakhstan is a little bit in the middle there, but they've been able to continue doing business. And Yellowcake has done really well. There have been times where they've been, they've had enough cash where they've even bought back shares because they've been trading at a discount to the uranium price. So the financial engineering there has been really interesting. But yeah, really big success. And they were followed by a North American player, Sprott, which did the same thing and bought up a lot of uranium as well. And the impact of those two on another small constrained market, commodity market, was to actually help push the price up as well. I don't think Cobalt Holdings will necessarily reach that level of scale anytime soon. So they bought 6,000 tons for $200 million in the market. I said supply last year was 250,000 tons. So it is a serious amount, but getting to that level of changing the market is probably not likely. And that's not the point either. But yeah, Jake Greenberg, who has done this vehicle, he was involved in Yellowcake as well. So has obviously seen that, and the idea here is picking a low, and with that floor, there shouldn't be too much risk here, and the reason that's important is someone has done this before, a company called Cobalt 27, which listed in Toronto a few years ago. It listed and was buying cobalt at $80,000 a ton. Price dropped, as did their share price. They'd basically just incinerated millions and millions and a few more millions of shareholder money. And I mean, it was such a crazy time that one of the warehouses holding their cobalt got burgled, and there's a theft worth millions of dollars in I think the Netherlands a couple of years ago. So it was a pretty hot market there for a while. I'm not sure we'll return to those heights, but by 2030, I don't know. There seems to be not a huge amount of downside to this. I could be wrong. I've been wrong in the past. But
I was going to add, I suppose for investors, it's the burgling is obviously a risk, but I suppose the point of these vehicles is to almost reduce the entire risk to price rather than price plus things going wrong in a mine, governments expropriating mines, et cetera, which is such a bugbear of investing in primary supply, isn't it? That actually you're kind of betting on a warehouse being securely managed more than anything else.
Yeah, and I think, I mean, the positive of of basically the rest of the mining sector is that operational gearing, where you can grow profits much faster than the underlying prices. But I mean, and the focus on something like this, Yellowcake is currently under some pressure from investors who think its cost base is too high. I mean, they have 2 permanent employees, and that there's a bit of criticism over that. So I think managing those expectations of it being almost like an exchange traded product, or exchange traded commodity versus a PLC metals vehicle, I think is interesting as well. So they've only just listed, but yeah, so it's something new. It's nice to have something new on the exchange as well.
Yeah, there haven't been many listings, as we're all aware, for some time now. Anyway, there is more detail on that online. Look at the article if you have an interest. But we've run out of time for today, so thank you very much to both Alexes, to Valeria, to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.